Welcome to the Transparent FX Academy. If you're new to the channel, I'm Nick and I've been a top author on TradingView for many years, as well as being one of the only traders with a fully verified MyFX book track record. So if you want to elevate your trading, you're definitely in the right place. So subscribe to the channel, and without further ado, let's jump right into it. So take a second, pause the video, read the disclaimer, and I will see you on the charts. In this video, I'll speak about gold. Now, as usual, to keep the video as educational as possible, first I'll give you the technical aspect, then I'll move to the commitment of traders analysis to see what institutions in the market are doing and how they are moving and shifting their orders, and then I'll put together these two different types of analysis. So this is definitely a video you do not want to miss. Now, starting here from the monthly time frame, what we can see is that we have a market which at the moment is in a very strong uptrend. The market has been creating a series of monthly higher highs and higher lows. All this push to the upside is fueled by strong institutional buying, and that is something that we will look about in just a few moments when we move to the commitment of traders analysis. Now, let's also keep in mind that all this uptrend has started as a break, retest, and rejection to the upside away from a quite important historical structured zone. This level was acting as previous monthly resistance preceding all these rejections to the downside. Then the market broke back above that zone with this impulse to the upside, and at that point all that previous resistance became support here. The market retested that previous resistance or support and rejected it to the upside. And that is exactly what you expect when you see a strong historical structured zone which was respected in multiple occasions in the past as resistance. Once it is broken to the upside, you expect a retest and a strong rejection to the upside, because you expect this previous resistance to become support, the market to test what kind of liquidity there is inside of the area, and then to start the push to the upside, which in this case is exactly what the market did. And so far, the market has been rejecting to the upside this level quite aggressively, creating all this huge uptrend, which is fueled by both institutional longing and very strong fundamentals. And so far, we are still in this uptrend. Let's keep it in mind and drop down on the weekly time frame. Now, on the weekly, we can notice two patterns that the market has just created, and one of them is actually still being created and the other one is already completed. The first pattern we have to speak about is the one that we see right here. This is in ascending triangle formation. When you see something like this, in which you're seeing higher lows being created, so buyers are still in control of the market because they're creating higher lows every time, but at the same time, equal highs are being printed. This means that sellers are trying to protect this level, but buyers are still in control, because if sellers would have been in control, they would manage to create lower lows. Instead, the market is creating higher lows every time, and it's only a matter of time before there is such pattern where usually you see the breakout to the upside and buyers remain in full control of the market. And in fact, that is exactly what happened. We had the ascending triangle formation. The market broke out to the upside from this pattern, which again is exactly what you expect with such a pattern. And then we had a huge breakout phase and impulse phase to the upside. After an impulse, for every market, what you expect is a correction, because no market can just continue to go up in a straight line. Every market will need a series of impulses and corrections. And that is exactly what we got here. We got first the impulse, and now we're getting the correction. Now, if you want to measure the correction, you have to take your Fibonacci from the low to the high of the impulse leg. And in this case, what we can notice is that we have the 0.32 and 50% retracements lining up exactly in this area. Now, why is this such an important zone? Because the 0.32 and 50% retracement zone is the area inside of which you expect to see a reversal if you have a very strong uptrend. So if the uptrend is a strong one, you usually see a series of impulses and corrections, with corrections which retrace in between the 0.32 and 50%. So if this uptrend is to continue with such a strong fashion, there is an increased probability that we will see the reversal starting from this area. Just a quick interruption. Let me know in the comments below any new pairs or topics that you would like me to cover in my next videos, because I'm always open to suggestions. Dropping down on the daily time frame, what do we see? Now here in the daily, the situation is quite clear. We have a market which, first of all, I spoke about gold just a few days ago when the market was around this area. I explained all the reasons for which I was expecting the correction. And by the way, I will link that previous analysis in the description so you can go and check it out for more free education. But now that the market has created a correction, what do we have? Well, first of all, in creating this push to the downside, we must notice how the market has created this M pattern. Now, when you see an M pattern, what you usually expect at some point is the rejection to the upside, completing the M pattern at the neckline. Now, why is that? Well, the psychology behind the pattern is that if you see an impulse correction, the market starts going higher, most retail traders will start longing this market and they will have stop losses below this level. So if the market then goes and wipes out all those stop losses, that is all added liquidity which institutions can actually use to buy. They can use all this stop loss hunting to actually buy. So after an M pattern, there's usually a good probability of seeing a reversal higher, completing the pattern at the neckline. Let's see if I can check. For example, you can see right here, we have an example of an M pattern. We have one here. After the M pattern, the market completed it at the neckline. We have another M pattern here. After that, the market completed at the neckline. So it's a popular pattern and a way in which the market likes to move. It's not obviously every time, but there is an increased probability. So in a situation like this, where we are essentially in a potential accumulation area from which there is a possibility of a rejection higher, what would I expect? Well, before we dig deeper here on the daily, first, let's go and see what we have when it comes to the commitment of traders. Now, here we have a problem because since the US government is currently in a shutdown, which should end quite soon, but we are still in a shutdown, we're not getting the new data. So we have to rely on older data. Now, it's usually quite okay because institutions take a lot of time to change their positioning because they have such large orders. So we have to just play a bit more of a guessing game than usual. Now, what we can notice here is that the pattern was clearly one of an increasing of the net positions. We were going from 161.2k net positions all the way up to 266k net positions. So we were seeing a situation in which essentially shorts in the long term were getting decreased. We were going from around 80k shorts down to 66k shorts, but longs were getting increased massively. We went from 232k longs all the way up to 332k longs. So in this period, longs were getting increased and shorts were getting decreased. So institutions were positioning themselves aggressively to the bullish side for gold. So it is reasonable to assume that that has continued since the market is still in a strong uptrend, and especially that now we're seeing the correction, there is the possibility of seeing more institutional buying inside of this area, potentially pushing this price higher. So in a situation like this, what would I expect? Well, as usual, and as my students know very well, trading is reactive and not predictive. The monthly, weekly, and daily time frames combined with the COT data, those are the best time frames when it comes to the directional aspect of the market. However, when it comes to identifying early shifts in the trend of a market, the best time frames for that are the intraday time frames, so 4 hour and lower. Therefore, what I would expect is that if this market would shift from an intraday bearish to a bullish market, I wouldn't be surprised to see a potential rejection higher, completing this M pattern at the neckline. That definitely wouldn't surprise me. Now, everything that you see me share here on YouTube is just the tip of the iceberg. In fact, if you want to learn more, I really suggest that you head over to my website, which you find linked in the description. Here, you have the possibility to gain access to the best mentorship program in the world. You can get all my courses ranging from the very basics of charting all the way to the more advanced topics. You also have the possibility to gain access to the trading station software with the Telegram notification integrations, one-on-one private mentoring directly with me, the COT data software, which is the software that you often see me use in my analysis, and you also have the possibility to gain access to the entertaining live trading show. So essentially a live stream of all my trades as they're happening live every day. So my entries, exits, how I manage the positions, all streamed live every single day essentially in this Telegram channel, which is obviously private just for members. You also have the possibility to gain access to all my EAs. So essentially all my strategies, which you can then customize to your own preference. And here you see breakdowns of each and every one of my strategies, including a 10-year historical backtest of the strategy on high quality tick data. So essentially backtested on live charts. So basically, I would suggest that you go and check these ones out. And if you continue to scroll down past the testimonials, you will see that you have the possibility to join and gain automatically access with the email and password that you will create during the checkout process. So I really suggest to at least go and check it out. The link is in the description and I will see you in it. If you enjoyed the video, make sure that you drop a like and a comment. It really helps with the creation of new free analysis and education. And I will see you in my next video.